Markets fall in Europe and the US.
Fears grow over the stability of the banking industry.
Credit Suisse shares shed around a quarter of their value.
The turmoil that rocked US-based Silicon Valley Bank at the end of last week has now spread to Europe, with scandal-plagued Credit Suisse under attack after years of financial mismanagement.
And there's sort of contagion. People were scrutinising other banks more carefully, and Credit Suisse is seen as the weakest link.
The Swiss bank has been involved in a string of financial collapses that led to record losses in 2021 and 2022. On Tuesday, it admitted material weakness in its financial reporting. The largest shareholder, Saudi National Bank, then refused to provide further funding, prompting a run on its shares, which closed 24% lower last night. The Swiss regulator and central bank tried to hose down investor fears, saying Credit Suisse meets the capital and liquidity requirements imposed on systemically important banks.
I do think every bank out there right now needs to be prepared for antsy depositors who are going to be asking tough questions.
And Australia won't be insulated.
Our regulators are on top of things, our banks are well capitalised with strong liquidity positions, but it's still a reminder of the risks, the uncertainties and the vulnerabilities in the global economy as interest rates rise around the world.
Financial markets have backed away from a near-certain bet that the Reserve Bank would raise interest rates at its next meeting as central banks globally reassess the situation.
There's always a chance that the US goes into recession. We have to balance the risk of a recession with the risk of entrenched inflation that we can't get down.
A trade-off no one wants to make. Nassim Khadem, ABC News.
So, is the fear justified, or is the only thing to fear the fear itself? I spoke to Chief Investment Strategist at Barrenjoey, Damien Bowie. Damien Bowie, welcome to the business.
Oh, thanks, Alicia. A pleasure to be on.
Contagion is being spoken about as a huge risk in the banking sector. Why?
The issue is that we don't know who's exposed to who and by how much. And then secondly, I think people worry about the second round implications of that. So if certain counterparties are at risk of failing and we don't have as much trust happening in the interbank markets, that will affect a lot of other things in the system, like banks' willingness to lend, credit availability, price of funds and things like that. So we're all here sitting looking at what central banks are doing with interest rates and judging what the cost of capital is, but now we're introducing a new variable, which is a premium or a price for the uncertainty that we're feeling.
Well, Australian banks and financial institutions are very well capitalised. Regulation ensures that they are. How exposed are Australian institutions to the turmoil in the global financial system?
Look, the direct exposure of Australian banks to some of the things that have been happening in America and Europe is relatively small. For example, the direct exposure of Australian banks to some of the things that are happening in Europe is less than 3% of their book. So we're really not too worried about the direct implications. What we're really worried about are the indirect effects. So, for example, if banks become a little bit less trusting of each other, a little less happy to lend, they start to demand a little bit of a premium for borrowing and lending between one another, that will lift global funding costs for everyone. It will also impact the willingness of banks to lend to one another, as well as to outside those outside the system, like the private sector. So you would actually see a market-imposed increase in the cost of funds and a reduction in credit availability.
And when it comes to the fear about what's happening in the global financial system at the moment, is fear itself more of a concern, or are the things that you've just pointed to a real risk of being exposed?
The Main Street response seems to be in response to news flow, as well as seeing a whole lot of queues at banks, and it's very instinctive. People on Wall Street might say that that response was irrational because policymakers have provided guarantees and backstops to make sure that banks don't fall over. However, there are two counter-arguments to that. The first is, once this behaviour has started, it creates this uncertainty and a fear which gets a life of its own. And once you've actually let that genie out of the bottle, you can't easily put that back in. The second perspective is really asking, with the benefit of hindsight and with a bit more analysis and data, are depositors wrong to be questioning the integrity and the solvency of the financial system? This is a much more complex question. It goes to how unique certain banks happen to be or how representative they are of what's happening in the broader system. You know, Silicon Valley Bank and Signature Bank and First Republic Bank, they all have very unique features. But one of the things that all banks have in common at the moment is that they're borrowing at short rates, which are higher than long rates that they're actually lending at. So they're actually experiencing a bit of a margin squeeze.
The turmoil in the banking system, in a way, is putting downward pressure on global interest rate expectations ahead of a number of central bank decisions. In particular, the ECB's decision tonight, that's now clouded in uncertainty. What's the market expecting?
Yeah, so markets are still, they're uncertain, but if they had to choose, they're still siding with as-you-were policy biases, so continuing to hike rates, probably in 25 basis point increments as opposed to anything larger. I guess the issue is this: what central bankers are responding to are real economy signals, like employment and inflation and so on and so forth. Financial markets are basically saying that interest rates are too high for the markets themselves and the banking system. And there seems to be a bit of a disconnect, at least in terms of timing, as to where the interest rate should sit for financial markets and the interest rate should sit for the real economy.
Well, there's been thinking that the US Fed will keep raising rates until something breaks. Are we there?
Yeah, things are breaking. And the question is, the things that are breaking, are they systemic? Because if they are systemic, and they will result in a decent credit shock and bring down growth and bring down inflation, then yes, that will impact rate settings.
Damien Bowie, appreciate your insights. Thank you so much.
Thanks for your time, Alicia.